Good afternoon, everyone, or good evening, I guess, at this stage. I'm very conscious that I am the last session just before Joe and standing between you and a cold beverage or a glass of wine. So I'm going to take the advice I received earlier today from one of our licensees, and they said, please, you do have the graveyard shift, so I would suggest you be brief, and that's exactly what we're going to do. We are going to be brief today. Before I start, let me just introduce myself. I'm Monika Sookhee, and I'm the head of insurance for the Gibraltar Financial Services Commission for the Prudential team. The Prudential team is responsible for the prudential insurance supervision and authorizations of insurance companies. We also supervise insurance managers. I wanted to just extend my thanks to Startup Grind and also to Denise for inviting us here today to speak. Hopefully you'll find the topics quite interesting and useful, given that there have been topical discussions for today. So let me kind of give you a little bit of background. I've been involved in the applications or authorizations process for many years now. And one of the things I found in particular within my role at the GFSC is there's always been some sort of chicken and egg situation when we've come to applications. And I'll elaborate on that in a moment. But basically what happens is we ask for all of this information from an applicant. We'll ask for a business plan, an OSA, the capital, the funding, where the money's going to come from, who the people are, and so on. But there's obviously a bit of a difficulty because you might not know exactly what that capital arrangement's going to look like, what the funding's going to look like, and sometimes who the individuals are going to be. And taking that very much on board, we've often considered what the right approach would be to be able to get us to a place where we could kind of try and get to that stage where we can authorize a firm, but also have the information and knowledge that we need. So from there, the staged application approach was born. It's also been there to try and manage some of the timelines and the communication with firms. So one of the things I wanted to share about the staged application approach is that it's not to change any of the regulatory standards that we currently follow. I think as we speak and as we've heard from some of the audience members today and the panels, what we've heard is that the applications process is quite robust and it is quite detailed. And that isn't intended to change. We are going to continue to maintain the highest regulatory standards that are proportionate but also relevant for each of the firms. However, what it is intending to do is really streamline the process, really provide some structure to the process, because it's broken down into the various different stages. And ideally, what it's trying to achieve is some level of clarity, transparency, communication for the firms that we're working with and for the applicants, so that everybody knows exactly where they are at each stage. So what we don't want, or the outcome that we don't want to achieve, is you get into an application process and you don't know exactly when you're going to get out. That's not at all what we want to get to. What we want to get to is clear communication and milestones. We are now in stage 1. We have now completed stage 1. We are now in stage 2, and so on, so that we can move through the process and everybody knows exactly where we are at each stage. It's also intended to help enhance the speed to market, which is definitely some of the conversations we've heard today. I just wanted to clarify that within my role within the GFSC, specifically responsible for the supervision and applications of insurance companies, what I'll be talking to you about today will be the authorization, the staged approach for an insurance company specifically. Moving on. The above table, so the table in the slide kind of gives you an overview of the various different stages. What we've talked about in our guidance note and consultation is that for insurance companies, the mobilization systems testing stage isn't really expected. It's only normally expected when you've got a full stack insurer redomiciling into Gibraltar, because you're testing all the controls and processes at that stage. How I view this is more like a waterfall. So we start kind of at high level at the top, and we go through certain of the areas which we'll talk about in stage 1, and then we work our way down. Before this, though, I wanted to make sure I emphasize was that The pre-application process is still required. This, just because we're going through the staged approach now with applications, it doesn't negate the need for the pre-application process. That still gives us a really valuable tool with which we're able to engage with the firms early. We're able to kind of identify real clear showstoppers from the get-go and have a discussion about where the application's intended to go. So I'll move on to the stages. The next couple of slides anyway talk about the stages and the timelines, and I'll just cover it through over here. So on stage 1, we're basically looking at the high level. What is the business model? What does the insurance company want to do? How does it want to achieve it? What their numbers are going to look like, so do their financials make sense? And based on that, does their capital needs make sense? Do they have enough capital? Then we look at ownership and controllers, because we expect there to be some sort of idea of who's going to be controlling the company and what sort of supervisory or structure they're going to have in place so that we can understand the scope of group supervision. We'll also be looking at key individuals, because those are the individuals who are coming to us to set up the company. So those are the individuals we'll be looking at. We'll be doing a due diligence process on them and working through the information we have there. And other than that, of course, we'll be looking at insurance risk, because that's what we do. Once we're comfortable with that information, and that I could tell you probably takes about up to 5 months, depending on the quality of the application, we would then formally notify the applicant that they have moved on, that we consider that they are ready to move on to stage 2 and request the information that's required for stage 2. I think this is really important, and this is one of the key differentiators of this process. There's a signal at that stage to say that we are comfortable with all of the elements we've looked at stage 1, and now we're comfortable that we go into further detail on the aspects of stage 2, and so on. And after stage 1, which we expect to normally be the longest stage, because it is, we are looking at the vast majority of how the business is going to be operating and how suitable your capital is. After that, we then go into the other detailed elements, such as the compliance frameworks, the risk frameworks, and so on. And that's how we trickle down. Stage 2 is expected to last up to 2 months, and stage 3, up to another 2 months. It's at that stage that we would then start, once an applicant has successfully completed stage 3, we would start to consider when the decision-making process would be happening. So the papers will be drafted for committee, and the committee will then consider making will then meet to make a decision. You will know as we move through the various different stages where we are, what we need from you, and what our expectations are. So it provides that clarity. It provides that information that you need, or the confidence that you need to be able to go out, start securing your funding, to be able to go out to start looking for individuals that can join your company. And I think that is one of the key reasons why we're working in this way. It also means that you know that certain things have been tied down, so you're more comfortable. So you know that if something needs to change in stage 2, that it might necessarily, it would just be specific to that stage, as opposed to having to move backwards and forwards. The full application fee would need to obviously be received up front. Thought I would share that. And we will, of course, assign a supervisor to the application from when you successfully go through the pre-app process and get into stage 1 of the application process. Over here, I have linked some useful information that's available and literature that's available on our website. The reason why this is important is because the website actually has been developed to have a lot more information that has been previously been available as to what's needed in each of the various stages of the application process. So we've got an overview of the overall process, and then we also attach the comprehensive business plan that sets out the type of information that we require under each stage, and what would be expected from there. It's obviously not an exhaustive list, it's very business plan specific, but at least it provides a useful guide on what is needed. I'm now going to be handing over to Joe, who's going to take you through the dual captive regime.
Thank you, Monika. Good afternoon, everyone. Really good to see so many of you still here at this late stage in the day. The eagle-eyed amongst you would have spotted that I'm not Christian Menes. He was due to deliver this slot. Unfortunately, he was ill today, so I'm standing in for him. Sort of quite late notice from this morning. So apologies for the last minute change, and I hope I can do justice to his slides. As Catherine said, I'm Joe Perdoni. I'm a co-director of the Prudential team, but I also head up the systemic firms and incentive supervision team. I hope you'll find what will follow to be interesting, as I keep telling anyone who will listen to me that insurance is exciting. I think you've heard that from Nigel a couple of times this morning, and I do want to say I have found insurance to be an absolutely fantastic career. I'm going to go off script, which is always a bit dangerous for a regulator to do. But I've been in insurance for, over 30 years now, and I would recommend insurance as a career to anyone. It is a very broad church, as I think Nicholas was saying. There is something for everyone, whether you're into the really technical details or whether mathematics is your field or something else. It is a really, really broad church. I've been very lucky that I've travelled to many, many different countries during the course of my career. And I don't think, as an industry, we do enough to promote insurance as a career. I think we hide our light under a bushel, so to speak. It is a great career. We need to get out in the schools and really tell people how exciting it can be. Anyway, back to the script. I thought I'd start with why a dual captives regime and what we're trying to achieve. Post-Brexit, we've had the ability to diverge from European directives, as in the UK, and with the changes that we're now seeing that's being made to Solvency II or Solvency UK, or SUC, as they've helpfully termed it. Solvency II, as it currently stands, can be quite onerous for captives in terms of capital, reporting, function holders, etc. As Minister Nigel Feetham said, there is a desire to diversify away from UK motor, and the proposed changes are meant to allow us to compete and offer Gibraltar as a cost-efficient alternative to the traditional captive locations. The PRA coined the phrase, I think, strong and simple, and to this I would add safe. Thank you to Warren, who mentioned that word earlier too. Strong, safe, and simple, all the S's. This is essentially what we're trying to achieve with this proposed regime. You'll see the big red block on the slide. I should caveat that certain aspects of the scheme are still being considered by government and are subject to consultation, and therefore may be subject to change. And I suppose it also depends, when it goes out for consultation, the level of feedback we get back to make sure that we're hitting the mark in terms of what people are trying to, or what they're trying to achieve. This approach will be for pure or vanilla captives, ensuring first-party and group risks only, subsidiaries essentially of the same group and their own risks. There's not anticipated to be any direct coverage for consumers or third parties. To meet the strong, safe and simple criteria, we want the regime to attract firms with extensive financial resources. So quality over quantity, if you like. Where the criteria is met, the new captive will be able to access the lower capital requirements and lower reporting and regulatory burden offered by the regime. So as I said at the start, we are trying to simplify the current captive regime and reduce the requirements that are currently required under Solvency II. It will borrow from Solvency I to some extent, and provides alternative methods for risk mitigation that are simpler but deemed equally effective. As this is for a group's own risk and not third parties, the risks should be easier to mitigate. So some of the mitigation techniques envisaged are a parent company providing a capital support agreement, whereby the parent undertakes to inject capital to allow the captive to meet its obligations to policyholders in respect of those group risks. These support agreements have been used by the GFSC historically. It does create a counterparty risk, and hence the need for the regime to be open to financially secure groups, so the quality that I mentioned or referred to earlier. Additional examples are top-up premium adjustment clause, whereby the policyholder agrees to pay additional premium if the premium is found to be insufficient to meet the claims incurred and costs. Another is partly paid shares callable on demand from a financially strong parent, which is legally binding and effective under Gibraltar law. And finally, the pay as paid clause, which many of you will be familiar with. That in the event the assets available are insufficient to meet the obligations in full, the captive will pay the policyholder to the extent that the assets are available, and any shortfall only when the funds are received, for example, pursuant to the capital support agreement I referred to. So now let's get to some of the more detailed areas. In terms of governance and regulated individuals, the regime aims to reduce the number of individuals required in terms of executive and non-executive directors, as well as regulated individuals. And the ability here is for firms to use insurance managers, as they have done historically with captives. I think in one of the panel sessions I mentioned non-executive directors, and here I think on the slide we'll say that you can have a group non-executive director. Ideally, we'd like to have an independent non-executive director, but that isn't going to be mandatory under this proposed regime at this present time. So with respect to capital, the minimum capital will be 500,000, but the GFSC will maintain the ability to increase this to ensure that there are sufficient funds to ensure a controlled and solvent runoff. So again, the safe and strong points that I was mentioning earlier. In terms of solvency, we'll introduce a simplified annual solvency return to confirm that solvency is and continues to be met. As in the previous slide, the risk and compliance functions will be required, but these can be outsourced to an insurance manager. The point made earlier about having an actuary, that's also included within the proposed regime, that an actuarial function holder and an actuary will not be required. However, the base case that we would want to see is that there should be an annual independent actuarial review of reserves. However, the GFSC will maintain the ability to dispense with this in certain circumstances. And where we envisage this to be the case is if there are sort of very short tail liabilities that don't necessarily lend themselves to actuarial projections, or there's no added benefit from having that actuarial projection in place. And then finally, the internal audit function holder won't be required. So the other thing that I think was mentioned is also the level of reporting that's currently required under Solvency II. And what we're trying to do is look to ways in which that can be reduced for this new dual regime captive. So the aim is to only require that information that we necessarily need to effectively supervise the captive. So there won't be an ORSA required, but a simplified business plan with the firm's risk appetite statement. There will be a duty to report, which is very much akin to the core principle 12, where the regulator should be told about any major risk events or where those occur, if there's any threat to solvency or the claims paying ability. As I said, simplifies solvency reporting. So a number of the Solvency II reports that are currently required won't be. So the SFCR and the RSR. QRTs, obviously, we will look to put a more simplified reporting requirement in place. We'll still require audited financial statements, as we do with all regulated insurance companies and existing captives. As the dual regime is not a Solvency II entity, and as we heard from Mike as well in the dual captive session, there won't be any passporting rights to the UK. And I think we've already covered the risk mitigation points earlier. So what we're trying to do with this regime, again, is to try and make sure that we can reduce the operational and financial costs and to make this competitive with other jurisdictions that currently provide a location to captives. And then finally, I think the legal bit, or I suppose the boring bit for me, which is that the regime will be implemented through new regulations under the Financial Services Act 2019. It will create a new class of captive, which will be a Class B captive, and the regulations that are being proposed will just apply elements of the existing Solvency II regime, so they won't apply to the Class B captive. So I know that that's been a bit of a whistle-stop tour through the proposed regime. I hope that you have found this helpful and, dare I say again, exciting. I think that's it.
So Joe, don't leave the stage. There may be questions. We have a question over there. It may be for Monika, so you may have to be ready.
Thank you, and thank you for more information on the dual captive regime. The Class B, the new type of captive, the Class B captive, from what you know off the top of your head of the existing captives that are already in Gibraltar, do you envisage that some of those would they kind of fit into this category of some of the parts you outlined previously of what would kind of qualify for the dual captive regime? Can you see existing captives already here benefiting from this new regime?
So the discussions that we've had so far is that this would apply to new captives. I don't think we've looked further afield as to say, well, will some of the existing captives also be able to apply for this? So that hasn't been within, I think we're just trying to get a dual captive regime out there to start off with. I'm sure we will have further discussions on that.
Hi Joe, Mike from Artex. Hello there. Two questions from me. One is, we've talked a lot about speed to market today. So what are the proposed timescales for the approval of a new captive?
That's a very good question. And I don't deal with authorisation, so I'm not sure what the answer is. But I would assume that it would not be dissimilar to some of the captives that currently exist, but because it's a more simpler regime, it should be, if anything, it should be quicker, because we won't be asking you for all of the Solvency II stuff that we would be asking for in a normal authorisation. But I should really, perhaps I'm going off piste again, I should ask Monika.
With the microphone over
there. So so I'll take that as 3 months. Question.
You might say that.
Second question.
Depends on the quality of the application, as always.
Touché. Second question is, where is the competitive advantage against, say, the Guernsey captive regime? What's our differentiator to win business?
That's a very good question. And I think in the approach that we've taken in drafting some of the policy for this, we've been mindful of what other regimes have done. And I think that's why we've tried to pitch the capital at a lower level. But I suppose one of the things is that's been mentioned a couple of times is we're not looking to do a race to the bottom here. I think I've said in the presentation that we're looking at quality rather than quantity. I mean, that's something I sort of try and preach a lot when it's across the piece, not just for captives. It'd be really interesting when it goes out to consultation if there's particular feedbacks from because I'm conscious that Artex are based in Guernsey and they will know what works there and how potential captives could look at Gibraltar over and above Guernsey. So it'd be interesting to see what feedback comes back from this, because one of the things is there's no point in us issuing a dual captives regime that attracts no one. So that is not what we're trying to do. We are trying to diversify and make ourselves more competitive. I mean, we will implement whatever the government tells us, but it's up to them. So if they want to change that in any way, shape or form, then we will we will have some input into that because, again, at the end of the day, what we're looking for is a strong, safe, and simple regime. I don't think I really answered your question, but we'll try.
On the timing, it will follow the staged application approach, as with any Part 7 permission. We haven't really given it an SLS like we have over here for the various stages that will have 5 months for stage 1, 2, and 2. But I do expect the timeline to be significantly shorter than a full third-party motor insurer, for example. So that is something we're happy to consider once the process and the legislation is live and ready to be considered.
Mike, I'd just add that it all depends on the application because we do see that captives do present a lower risk than open market. So you should see that reflected in the turnaround time.
Hi, sorry, question. Could you clarify your position on third-party liability, please, and whether that applies to insurance and reinsurance transactions?
That's a good question.
Well done.
So what we're looking for is a pure captive. So where it is, the actual policy that's being issued is to the parent or the subsidiary. So no direct policy or direct cover to an individual third party. But I'm not quite sure I understand what you're asking.
Oh, okay. Yep.
Sorry, what I'm trying to clarify is if, for example, we had liability risks going through a captive, understand that, for example, for EL, there's no desire for Gibraltar to take direct EL on an insurance basis. However, it's a common approach is to have a front involved reinsuring to a captive. Is that something that you envision?
So I think in the discussions we've had so far, there's any statutory classes we're not looking to have captured within that. But if, sorry? Well, I suppose it depends on who your fronting insurer would be. Well, then I couldn't see that would potentially be an issue.
Okay, it's me, Joe.
Be
afraid. No, simple question. So
I'm not going to sing if that's
no,
what you're
I'm not
going
going
to
to sing. No. I've got a microphone. I'm not going to sing. Not tonight. Later, maybe. It actually kind of touches on what the gentleman there just covered. But presumably then, one of the things I noticed you said was no passporting, which
Yes.
is because it's not within the GAR, therefore we wouldn't automatically have the permission to write into the UK. So are you envisaging that we write business unadmitted, which I think Guernsey do in some cases and some classes? Or are you envisaging that these will be mainly reinsurance captives with a front, which the gentleman there mentioned?
So we said no passporting. So if there's no passporting right, then if you are going to write business in another territory where we don't have passporting rights, then it would be on a non-admitted basis. Yep.
Hi, Joe. How do you see this fitting in with the PCCs?
I don't think at the moment we've really looked at PCCs. I don't think we have. Don't think we've gone as far as that.
That was my question, so I'm happy to assist if you do want to get that far. But the lady asked you just before I was about to ask you.
I guess, Joe, you can take it back.
Yeah.
I think on the PCC question, I couldn't see anything in the regime that you described which dictates what the corporate structure of a company should be. So whilst it's kind of silent on PCCs, I can't see any reason why it wouldn't apply to PCC, because PCC is a corporate structure under another piece of legislation, but it doesn't mean that it's mutually exclusive with the dual captive regime, I would have thought.
So I think that's something that we'd need to think about a little bit more.
If the purpose of a PCC is rent a captive, which it is, Isn't it PCC the ideal solution?
Potentially, but one of the things I'm conscious of is if there's an existing PCC, what we don't want is sort of mixed bathing, if I can call it that, is where you've got or trying to get a Class B under an existing PCC that isn't a Class B. So there are some things we'd need to think about.
Okay. Any more questions for Joe or Monica? Are we going to let them go? Going, gone.
Sold to the man over there. Thank you.